have another episode of Verbal Weekly for you, and today's topic is economic terms you must know. Now, part of what we're going to cover in today's episode is general knowledge, but the reason that we still thought it's important to do this is that a lot of times when you're reading a passage, not knowing these terms might get in the way of your understanding the main idea. So, let's get started. Now, let's imagine that this is the passage that you were reading. Of course, it's a sample passage. While reading this, you might come across terms that we have highlighted. It looks like Europe is heading into recession. Now, most of us understand what a recession is, but let's keep reading further. Germany and Italy may already be in technical recession. Now, here we might pause and say, okay, so what is a technical recession and how is it different from a usual recession? And as you keep going, you will encounter more terms such as contraction, deficit spending, fiscal stimulus, and of course, something called austerity. So, in the end, it might leave you a little bit confused as to what the passage is talking about. We cannot possibly cover all the economic terms that you need to know, but this will help you get started. So, the first thing that we're going to discuss is, of course, fiscal policy. Fiscal policy is pretty simple. It refers to the use of government spending and tax policies to influence economic conditions. In very simple terms, it's the way government spends money and collects money from its citizens. So, it has two main components: taxation. Now, tax rates can increase or decrease the money in the hands of the people. Of course, if the tax rates are high, it means you have to shell out more money to the government, which means that you actually have less disposable income. If the tax rates are reduced, it means that people have more money to spend. And if you have more money to spend, it might possibly lead to greater demand. Now, how does government spending help the economy? When the government spends on a project or invests in an infrastructure project, for example, it requires people to work, which in turn generates more employment. More employment means more income for people, and more income obviously means more money. And the moment people have money, you know what they're going to do with it. They're going to want to buy things. And that is how it increases demand. So again, the two components of fiscal policy are taxation and government spending. Usually, the budget that the government presents gives us an indication of the fiscal policy because the budget is basically the plan for income and expenditure. Now, let's take a look at some related terms. Fiscal deficit. This is a very common term that we use. A deficit is a shortfall. It's a gap between income and expenditure. Now, usually, across countries, most governments face a fiscal deficit. The government usually spends more and collects less from the people. That's not necessarily a bad thing. However, if the fiscal deficit becomes very large, that might create a bit of difficulty. So the idea is to maintain the fiscal deficit within certain limits. So how do we measure the fiscal deficit? As a percentage of the GDP or the gross domestic product. Now, if you do not know what GDP is, most of us learn this term in school, but it is nothing but the monetary value of goods and services produced in the country. So that's a technical and a very general definition of GDP. Another related term that you might hear sometimes is called deficit spending. Now, what is deficit spending? Generally, it involves deliberately spending more money as compared to how much the government is getting from the people. So why would the government want to spend more? Obviously, to boost the economy. And we already talked about how government spending provides an economic stimulus. So let's move on and learn a few more words. Then we have something called the monetary policy. Now, a lot of people are confused between the fiscal policy and the monetary policy. One of the things we need to remember is that the fiscal policy is in the hands of the government or the elected representatives of the country. But the monetary policy is actually controlled by the central bank, which in our case is the Reserve Bank of India. Now, the purpose of the monetary policy is kind of similar to the fiscal policy. The idea is to control the overall money supply in the economy and maintain healthy economic growth. So, how does the central bank do that? Again, usually by revising interest rates. How does interest rate really matter? So, for example, if the interest rates are high or if they're increased, it is likely that less money will be circulating in the economy. On the other hand, if the interest rates are reduced, usually that means that more people are able to borrow money from the banks and there is more money in circulation. So, the banks are actually the means by which the monetary policy operates. Now, changing bank reserve requirements. So, a lot of us have heard of something called the CRR. Now, we do not really need to go into the details of various ratios because that will take a long time, but a very simple way to understand it is this. The more money that circulates in the economy, generally it means that people have more money to purchase things. So, if the reserve requirements are low, it means that the bank keeps less money with itself, which means that there is more money in circulation. If the reserve requirements are high, it means more money stays within the bank and there is less money circulating in the economy. And now we come to a term that most of us have heard of, recession. It's not a complicated term, but we do need to understand exactly what it means. So first of all, when we say that an economy is in recession, it means that there is a significant, widespread and prolonged downturn in economic activity. Now, there are multiple ways to measure whether the economy is doing well or whether it is in recession. But there is a technical definition that we need to know. If you recall, the passage that we read talked about a technical recession. So what is a technical recession? 2 consecutive quarters of decline in the GDP is a technical recession. Now, a recession can last for a few months. Most cases, it lasts for 6 months or more. It can probably spread across a year or more as well. Now, the problem is that if we do not control the recession, it might lead to a more severe economic crisis that is normally known as a depression. Now, thankfully, we have not really seen a depression in the true sense of the term. The last depression that most people have talked about is the Great Depression of 1929. Now, what is the difference between the recession and a depression? It is just severity, that's it. A recession can last for months, maybe a year. A depression usually takes a much longer time to recover from, and the effects of a depression are a lot more widespread. Now, what exactly is an expansionary policy? Whether it is a fiscal policy or a monetary policy, if we are trying to deal with a recession, we have to boost demand and allow more money to circulate. So, expansionary policies usually involve reducing interest rates, increasing government spending, and of course, reducing taxes. So, the government of a country may use any or a mix of these strategies to deal with a recession and prevent it from spiraling out of control. Let's talk about an economic stimulus, which is very relevant to the last thing that we were talking about, an expansionary policy. So, what exactly is an economic stimulus? It is targeted fiscal and monetary policy that is intended to elicit some sort of a response from the private sector. So, the reason it's called a stimulus is that we are using that whole biological parallel of stimulus and response. So, there are fiscal and monetary actions that are taken, and we hope that the private sector or business will respond to these stimuli. Usually, these policies are employed during recession. We have already discussed how these policies work. So, fiscal stimulus measures usually involve deficit spending. If you recall, this is where the government spends more money in order to boost employment and therefore increase demand, and of course lowering taxes so that people have more money to spend. Now, monetary stimulus has to do with the money supply in the economy. So, these are measures taken by the central bank, and generally they involve lowering interest rates. Now, here we need to be a little cautious because if interest rates are low and a lot of money is circulating in the economy, that might lead to another problem called inflation. So, inflation is not really something we're going to talk about in today's episode, but on the whole, it is a general increase in price level. So, when the economy is in recession, we do need to correct it, but we also have to make sure that it does not go to the other extreme. So, everything needs to be in balance. In order to understand balance of payments, we need to think of the country as any other business. So, it would have certain financial transactions and we would maintain a record of these transactions. So, the balance of payments is nothing but that. It's a record of all the economic transactions in goods, services and assets of the country and the rest of the world. So, think of it as an exchange between India and the rest of the world. Everything that goes on between India and the rest of the world is reflected in the balance of payments. Now, this usually has 2 main components. Of course, there are debit and credit transactions, but these are not the 2 components we are talking about. The 2 main components of the balance of payment is the current account, and these terms you do need to know, So the current account, without going into too much detail, generally includes imports, exports, and transfer payments. The second component is what we call the capital account. So this involves international sale and purchase of assets. Assets are things like stocks, bonds, foreign investments, and loans. Together, the current and the capital account makes up the balance of payments. Now, on the whole, when we say balance, it ideally means that our debit and credit transactions should be equal, but in reality that never happens, of course. So, let's talk about a scenario where the balance of payments is so skewed that it leads to a crisis. Now, we're going to talk about this in the context of India's economic history. Some time ago, specifically in 1991, India was facing a balance of payments crisis. So it was a pretty bad situation. This crisis, of course, was a result of multiple factors. It was not sudden. It was an outcome of mismanagement over a period of years. But what happened was that there was a huge balance of payments deficit, primarily because we were relying on imports a lot more than we should have, and we were not exporting as much. There are a lot of other things that contributed to it, but as of now, let's understand what the implication of it was. So by the end of 1990, we were in a situation where we had enough foreign exchange to finance only 3 weeks worth of imports. So we were basically facing financial bankruptcy as a country. And of course, you can imagine how serious the situation is. So what is it that really happened? We wanted a bailout. So we sought an economic bailout from the International Monetary Fund. Now, this was not very easy. In order to secure an emergency loan from IMF, we actually had to pledge our gold reserves. So again, let's not go into what these gold reserves are, but we had a certain amount of gold, very similar to how Indian families maintain gold reserves. But in a moment of crisis, you might go and mortgage that gold in return for money, and that's exactly what our country had to do. Not only that, we had to physically airlift our national gold reserves to the Bank of England and the Swiss bank. And that's an entirely different story that we're going to cover just a few slides down the line. So, we were in a crisis, we sought a loan. In return for that loan, we had to pledge or mortgage our gold. Now, this did have a good ending, however. So, in 1991, this crisis, which we did overcome, paved the way for economic liberalization of the country. Again, something we will talk about just a few slides down the line. Feel free to look up any of these terms and research these events, and you will get a much better picture of what actually happened. Now, in a lot of cases, usually when a country faces an economic crisis, one of the methods that a country might use is something called austerity. Now, we've not really used this word in India, but in a lot of countries this has happened. So let's talk about what austerity is. On the whole, when the government is facing an economic crisis, just like if we were about to face bankruptcy, we would normally try to curtail our expenses and try to generate more income. And that's exactly what austerity is intended to do also. So it refers to strict economic policies that the government imposes to control growing public debt, because the government does not want to borrow more money because it's already kind of facing a crisis. So these measures are usually put in place where government or public debt is so large that the government runs a risk of not being able to meet its financial obligations. So for example, in the case of India, we were exactly at that stage. Normally, austerity measures involve doing two things. The first is restructuring government programs to reduce expenditure. And secondly, obviously, to increase taxes, because that is one of the main ways in which the government can generate some income. And secondly, of course, increasing taxes, because that is the government's source of income. Now, austerity sometimes seems necessary, but it has been controversial wherever it has been implemented. Because when we impose such extreme measures, usually it leads to a downfall in the standard of living of the citizens of the country. And people also say that it in fact leads to increase in unemployment and poverty. So as usual, drastic action does not always produce positive results. Now let's get back to the story of India. If you recall, when we were facing the balance of payments crisis, we sought an emergency loan. Now that is an example of what we call a bailout. So when someone bails you out, they're basically throwing you a lifeline. In this case, an economic bailout normally means that someone is providing money or resources to help a company or a country facing an economic crisis. This provision of money or resources is also called capital injection. It's not only in the context of a country, this also happens in the case of companies and, of course, in the case of banks. So, after our crisis in 1991, as we mentioned earlier, we tried to secure a loan. It was a pretty big loan. It was about $2.2 billion. And in return, we had to pledge 67 tons of our gold reserves, which was quite a bit of gold. There are some other interesting facts which are not really necessary to understanding bailout, but I thought it's pretty interesting and therefore we should mention it. So, we had to actually airlift our gold to the Bank of England, and of course 20 tons of gold went to the Union Bank of Switzerland. Now, on the way to the airport, because the gold had to be airlifted, the vehicle that was carrying the gold stalled, primarily because of a tire burst which led to a lot of panic. And the other side of the story was that this entire operation had to be done in secrecy because our country was in the midst of the elections. So again, read about this story and you will get to know the bigger picture. The story, however, has a happy ending, at least till that point of time, because this crisis paved the way for economic liberalization. So what exactly is economic liberalization? It refers to reduction or complete elimination of government regulations and restrictions on private business. So effectively, we are trying to allow more freedom to private enterprise. There are several things that are normally included or associated with liberalization. One of them is, of course, deregulating the markets. The second is reducing taxes and government spending. The third is privatization and promoting free trade. So, after the economic liberalization program that we started implementing in 1991, it did us a lot of good. It not only helped us overcome the crisis that we were facing within a short period of 2 years, it reduced poverty, it brought in a lot of foreign direct investment, it boosted our exports, and of course, as an economy, we became a lot stronger. But as usual, every story has two sides. This liberalization program is also blamed for increasing income inequality and increasing concentration of wealth. And in fact, people also claim that it has contributed to impoverished conditions in rural areas and increased farmer suicides. So, every story has two sides. You should read a little bit more about the economic history of India and about these economic terms in general to get a better idea. I hope this episode was helpful. See you next time.